Welcome to a new episode of Inside the Economist's Mind. Today we're diving deep into the balance of payments, what it is, why it matters, especially for an open economy like Australia, and really how it all fits together.
Exactly.
We'll be unpacking key insights from the Balance of Payments document. And our mission today, for you, the learner, is to give you a clear, concise understanding of this, well, pretty crucial economic indicator without it feeling too overwhelming.
Yeah, we want to cut through the jargon.
We'll pull out the most important bits to help you get well informed. So let's just jump right in. What is the balance of payments in simple terms?
Okay, so think of the balance of payments as like a country's financial diary with the rest of the world.
Yeah.
It logs all the economic transactions, money coming in, money going out between Australia and everyone else over a set time, like a quarter or a year.
A financial diary, I like that. And for an open economy like Australia, that diary must be pretty full.
Absolutely. Because we trade so much, we invest overseas, foreigners invest here. It's vital. It tracks the flow of actual resources, goods, services, money between us and our global partners. It shows how everything connects financially.
Okay, and when we talk about us, who counts as an Australian resident for these records? It's not just about citizenship, is it?
No, not strictly. Resident here is more of an economic concept. It means individuals usually living in Australia, companies operating here, the Australian government itself, and, other organizations primarily based in the country.
So where their main economic interest lies.
Precisely. It's about that economic center of gravity.
Right. So this big diary, this comprehensive record, how is it organized? You mentioned connections.
Yeah, it's split into two main sections, two broad accounts. There's the current account, and then there's the combined capital and financial account. You could almost picture them as two sides of a scale. They have to balance each other out.
Okay, two sides of a scale. Let's start with the current account. What goes in there?
The current account, it basically captures the money flow from day-to-day international dealings. Think trade, mostly. It's the net flow of money from selling goods and services abroad versus buying them from overseas. Plus, income earned from abroad minus income paid out.
So short-term stuff, like things consumed or earned right now.
Exactly. That's why it's called current. It covers transactions typically completed or income earned within the current period.
And you said there are components within that.
Yes. Three main parts to the current account: the trade balance, the primary income balance, and the secondary income balance.
Okay, trade balance. That sounds like exports minus imports.
That's the one. It's the difference in value between what we sell overseas, our exports of goods and services, and what we buy from them, our imports.
And why is this one mentioned so often? I feel like I hear about the trade balance all the time.
Well, it's a biggie because it directly impacts our gross domestic product, our GDP. Exports add to GDP, imports subtract. So a trade surplus gives the economy a boost, while a deficit kind of pulls it back a bit. It's a core measure of how we're doing internationally, trade-wise.
Right, okay, direct link to GDP. Got it. What about the next one, primary income balance? What's that tracking?
Primary income is about earnings related to the factors of production, essentially labor and capital. So it tracks income Australians earn from owning foreign assets like dividends from overseas shares, interest on foreign bonds, profits from Aussie companies operating abroad minus the income foreigners earn from their Australian assets, like dividends paid to overseas shareholders or interest paid on Aussie debt held abroad. It also includes wages, like money sent home by Aussies working overseas or paid to foreign workers here.
Okay, so income from investments and work crossing borders.
Exactly.
And the third part, secondary income balance. That sounds a bit different.
It is a bit different. Secondary income covers transfers where there isn't a direct economic exchange. Think one-way streets. It has two bits. First, some government transactions like, say, taxes paid by non-residents to the Australian government or tax refunds going the other way. Second, it includes what are called current transfers. These are transactions where something is provided goods, services, money without getting anything specific back in return right then.
Like foreign aid.
Precisely. Like Australia sending emergency food aid after a natural disaster overseas, that's a current transfer. It's usually for immediate consumption or needs.
Okay, makes sense. So that's the current account trade, primary income, secondary income.
Right.
Now the other side of the scale, the capital and financial account. What's its focus?
Right. So if the current account is about the immediate flows of trade and income, the capital and financial account is about changes in ownership. It tracks Australia's net change in its assets and liabilities with the rest of the world. It's more about the investment side, the financing side, how we pay for things internationally, or how others invest here.
And that's split too, into capital account and financial account.
Yes. though the capital account is usually much smaller than the financial account.
Okay, let's tackle the capital account first then. What's in there?
The capital account primarily covers two things: capital transfers and dealings in non-produced, non-financial assets. Now, capital transfers are also one way, like secondary income transfers, but they typically involve the transfer of ownership of fixed assets or debt forgiveness. It's more about changes in wealth. Think of, say, migrants transferring their assets when they move countries, or a government canceling a debt owed by another country.
Bigger, lumpier transactions related to assets.
Kind of, yeah. And the other part, non-produced, non-financial assets, sounds complicated, but it mainly includes things like patents, copyrights, trademarks, intangible assets, and also rights to use natural resources like buying or selling mining rights or fishing quotas across borders.
Okay, intangible stuff and resource rights. Got it. So the financial account must be where the really big money flows are tracked.
Exactly. The financial account is the main event, you could say. It records transactions involving Australia's financial assets and liabilities with the rest of the world. It's broken down by different types of investment.
Let's go through those types. First up, direct investment.
Direct investment, or FDI, foreign direct investment, is when an investor aims to have a significant influence or a lasting interest in a business located in another country. Usually this means owning 10% or more of the voting power. Think of a foreign company setting up a factory here, or an Australian firm buying a controlling stake in an overseas tech company. It's about control or significant influence.
Right, more than just buying a few shares. Which brings us to portfolio investment. How's that different?
Portfolio investment is more about purely financial returns. It's buying shares, equity, or bonds, debt in foreign entities, but without getting that significant influence. So you might buy shares in Apple or U.S. Treasury bonds, but you're not trying to run the company or influence U.S. policy. It's generally more liquid, easier to buy and sell than direct investment.
Okay, less control, more about the potential profit. Next, financial derivatives. These always sound complex.
They can be quite complex, but fundamentally, a derivative is a financial contract whose value is derived from something else, an underlying asset, like a share, a bond, a currency rate, or even, say, a commodity price. People use them often to manage risk, like hedging against currency fluctuations or interest rate changes. It's about transferring risk rather than directly investing in the underlying thing itself.
Okay, risk management tools. Then there are reserve assets.
Yes, reserve assets are specific foreign currency assets held by the central bank, in our case, the Reserve Bank of Australia, RBA. These are things like foreign government bonds, foreign currency deposits. The RBA holds them for policy reasons, maybe to intervene in the currency market, to smooth out the Aussie dollar's value, or just to ensure we can meet our international payment obligations.
Right, the RBA's toolkit. And the last one is other investment, a bit of a catch-all.
It is, yeah. It covers transactions that don't neatly fit into the other categories. Two big ones are trade credits, which is basically when payment for exports or imports is delayed.
Like in that iron ore example earlier.
Exactly like that example. And the other big one is currency and deposits. This captures money moving between Australian and overseas bank accounts, and also the physical movement of banknotes and coins across borders.
Okay, so that covers all the types of flows. Now, you mentioned this idea of the accounts balancing. How does the accounting actually work? Something about double entry.
Yes, double entry bookkeeping is absolutely fundamental to the balance of payments. The core idea is that every single international transaction has two sides, representing a flow of equal value. Something of economic value is provided and something of equal value is received. So the system records both sides. A credit entry, shown as positive, is recorded when Australia provides economic value to the rest of the world, like exporting goods or receiving investment from overseas. A debit entry, shown as negative, is recorded when Australia receives economic value, like importing goods or investing overseas. And for any single transaction, the credit and debit entries must be equal in value.
So let's revisit that wool export example. We export wool. That's providing goods, so that's a credit.
Yes, exporting wool is a credit in the current account under goods trade.
And the payment we receive, where does that fit? Is that the debit?
Good question. The payment received also creates an entry. If the payment comes into an Australian bank account from overseas, that's an increase in our foreign financial assets or decrease in liabilities. This inflow of funds is actually recorded as a credit in the financial account, likely under other investment currency and deposits.
Wait, so two credits. How does that balance?
My apologies, let me clarify that. The export itself is a credit, current account goods. The corresponding financial flow depends on how it's paid. If the foreign buyer pays immediately by transferring money to the exporter's Australian bank account, this increases Australia's claims on the rest of the world. In the standard presentation, the increase in the exporter's foreign currency deposit asset would be a debit entry in the financial account, reflecting the acquisition of a financial asset, the claim on the foreign bank.
Okay, export credit, current account. Increase in our financial claim asset, debit, financial account. That makes more sense. One positive, one negative, same amount.
Exactly. So because every transaction creates equal credit and debit entries across the whole system,
In theory, everything should add up to zero. The total balance of payments should balance perfectly.
theoretically, yes. The sum of all credits should equal the sum of all debits.
But it doesn't always in practice, right? The document mentions net errors and omissions. What's that about?
Right. That's the reality check. Compiling this data is incredibly complex. You're trying to capture billions of dollars in millions of transactions across borders, using surveys, customs data, lots of sources. Inevitably, there are measurement issues. Maybe a good is valued slightly differently at export versus import, and some transactions just get missed entirely. They're omitted.
So the data isn't perfect.
Not perfectly, no. So net errors and omissions is essentially a plug figure. It's a statistical adjustment added to make the final balance of payments sum to zero, acknowledging those data gaps and discrepancies. It's the statistical system's way of saying, okay, we know it should balance. Here's the bit we couldn't quite pin down.
A statistical balancing act. Okay. So going back to the two main accounts, current and capital and financial, you said there are two sides of a scale. How are they linked?
The core relationship is this. The balance on the current account and the balance on the capital and financial account must, by definition, including net errors and omissions, sum to zero. So if the current account is in deficit, meaning we're spending more overseas on imports and income payments than we're earning from exports and income receipts.
We must be financing that somehow.
Precisely. That deficit has to be funded. And the funding shows up in the capital and financial account. It means, on balance, we've either been borrowing money from overseas or foreigners have been investing more in Australia, buying assets like property or companies, or we've been selling off our own foreign assets. These inflows of capital create a surplus, a net credit, in the capital and financial account that exactly offsets the current account deficit.
So a current account deficit implies a capital and financial account surplus and vice versa.
Exactly. Think about Australia historically. We've often run current account deficits. Why? Partly because we're often investing more building mines, infrastructure, than we save domestically. So we attract capital from overseas to fund that investment. That inflow shows up as a surplus on the capital and financial account. Of course, that borrowing or foreign investment means we then have to pay interest or dividends back to foreigners later.
Which contributes back to the current account deficit through the primary income balance.
You've got it. It's a cycle. A current account deficit isn't necessarily bad if the foreign capital is funding productive investment that generates future growth and income. But it highlights that link trade and income flows are financed by capital and investment flows.
That really clarifies the connection. The document had some great examples in a box. Maybe running through one or two could help cement this.
Right.
How about that iron ore export?
Sure. So Aussie company exports $100 million of iron ore. Payment is delayed. It's on trade credit. Step one, the export itself. Providing goods to the world. That's a credit of $100 in the current account under the trade balance for goods. Step two, the financing. Because payment is delayed, the Aussie company has effectively extended a loan to the foreign buyer. This increase in Australia's financial assets, a claim on the foreigner, is recorded as a debit of $100 in the financial account under other investment trade credit and current, debit and financial balances.
Okay, credit for the good, debit for the loan created by the delayed payment. Makes sense. What about the example of Australians holidaying overseas, say in Bali?
Right. Aussie spend $5 million on hotels, food, tours in Bali. That's Australia importing tourism services. Step one. Importing services means we receive economic value from overseas. That's a debit of $5 in the current account under the trade balance for services. Step two. How is it paid for? Typically, Aussies use money from their Australian bank accounts. This outflow, reducing our foreign assets or increasing liabilities if they borrow, shows up as a credit of $5 in the financial account under other investment currency and deposits. Debit and current, credit and financial. Again, it balances.
Debit for the service import, credit for the money flowing out to pay for it. Got it. One more. An Aussie buying shares on the NYSE.
Okay. An Australian resident buys $20 million worth of shares in a U.S. company. Let's assume it's less than 10%, so it's portfolio investment. Step one. Acquiring a foreign financial asset.
Hmm.
This outflow of investment capital is recorded as a debit of $20 in the financial account under portfolio investment equity assets. Step 2. The payment. The money leaves the resident's Australian bank account to pay for the shares. This decrease in Australian-held foreign assets, the money, is recorded as a credit of $20 in the financial account under other investment currency and deposits.
Ah, so in that case, both the debit and credit are within the financial account.
Yes, exactly. One type of financial asset, shares, goes up, debit. Another type, cash deposits, goes down, credit. It reflects a change in the composition of Australia's foreign assets, but the net financial account position from this specific transaction is balanced within itself in this simplified view, though ultimately that cash had to come from somewhere linked to other transactions.
Fascinating. Seeing the double entries for specific examples really brings it home. And that stylized table in the document helps visualize all the pluses and minuses.
It does. It shows how it all nets out across the different accounts, eventually summing to zero once you factor in that net errors and omissions line.
Well, this has been incredibly helpful. A really clear deep dive. So just to recap the big picture, the balance of payments is like the nation's comprehensive economic scorecard with the world,
Yeah, tracking trade, income, investment.
and showing that crucial interplay between the current account, our immediate earnings and spending, and the capital and financial account, how we finance it all through asset movements.
And the double entry system ties it all together, ensuring it balances, giving us those key insights into our economic health and how we interact globally.
Understanding this really does empower you, the listener, to see beyond just the headlines about trade deficits or foreign investment and grasp the bigger economic picture for Australia.
Absolutely. You can see the mechanics underneath.
So here's a final thought to leave you with. Think about major world events. Maybe a global financial crisis, a pandemic shifting trade routes, or even a boom in demand for a key resource Australia exports. How would events like these ripple through the different parts of the balance of payments we've discussed?
Yeah, how would they hit the trade balance? Primary income, foreign investment flows, even those reserve assets.
And digging a deeper, what does it really signify for a country like Australia if it consistently runs a current account deficit alongside a capital and financial account surplus? What does that reliance on foreign capital imply for our long-term economic path and maybe even our vulnerability to global shocks? Something to definitely mull over.